We are going to talk about FIFO in this video. FIFO stands for first in, first out. It is one of the 4 inventory cost methods. Under the FIFO methods, the first costs into inventory are the first costs assigned to cost of goods sold, hence the name first in, first out. Ending inventory is based on the latest costs incurred, while cost of goods sold is based on the earliest cost. This method can be tricky. I recommend that you write each item down and carefully track it. If you try to plug numbers into your calculator, it's very easy to get lost. Let's go through an example of using FIFO. We will use the same set of data we used for an earlier video on the average cost method. In May, Shade Company had a beginning inventory of 30 pairs of sunglasses that cost $10 each for a total cost of $300. During the month, Shade purchased another 20 pairs at a cost of $15 each for a total cost of $300. At the end of the month, Shade had 10 pairs of sunglasses left in ending inventory, having sold 400 pairs during the month. Calculate Shade's cost of ending inventory and its cost of goods sold for May. I'm going to highlight the critical pieces of information in that data set now. First, we see that beginning inventory consisted of 30 pairs of sunglasses that cost $10 each for a total cost of $300. Next, we see that the company purchased another 20 pairs of sunglasses at a cost of $15 each for a total cost of $300. At the end of the month, the company had 10 pairs of sunglasses left in ending inventory. We don't know the cost of those sunglasses in ending inventory, so we're going to have to apply FIFO principles to get that cost. And finally, the company sold 40 pairs of sunglasses during the month. Again, we do not know the cost of those sunglasses sold, and that's why we are applying the FIFO method. We're going to start by summarizing the data in a table format. Beginning inventory was $300, which came from multiplying the 30 units by the $10 each. Purchases were $300, which came from 20 units purchased at $15 each. The total cost of goods available, therefore, was $600, which was the beginning inventory plus the purchases. The total units available for sale were 50 units, which came from 30 units in beginning inventory plus 20 units of purchases. We will be calculating ending inventory and cost of goods sold. I know this is a lot on the screen, but we're going to talk through it. Ending inventory is from the newest units, since FIFO means that the first ones in, the oldest units, are sold first, leaving the newest ones in ending inventory. The ending inventory is $150, which I got by taking the 10 units in ending inventory and multiplying by the $15 price that came from the purchases. The purchases were the most recent units in, and with FIFO, ending inventory is always the most recent units. Now to calculate cost of goods sold. Cost of goods sold starts with the oldest units. 40 units were sold, so all 30 of the units in beginning inventory were sold, plus another 10 from purchases to get the 40 sold total. We will take 30 units from beginning inventory at $10 and add 10 units from purchases at $15 to get our total cost of goods sold of $450. There's another way to calculate cost of goods sold if we already have ending inventory, and it's easier. To calculate cost of goods sold, you can also take the cost of goods available minus ending inventory, or $600 minus $150 gives us $450 as our cost of goods sold. That's it on this example of the FIFO method. It can be complicated, but if you take your time and write down each step, you can do it. This video was created and narrated by Dr. Sell-Tietz. Have a great day.